Hey traders, this is a training video on one of our favorite trading strategies in the trading room. It is the in the money cover, and it is an in the money covered call. It can also be an in the money covered put. Could quite possibly be referred to as maybe the best trade ever. All right, let's get into this and talk about the in the money covered trade. Could be an in the money covered call. Also, we use in the money covered put trades. But before we do that and get into the three main steps of this trade setup and strategy, I want to talk briefly about this idea of the quote unquote best trade. That's such a loaded word in the world of investing and traders. Everybody has their own idea about what is the best trade. And again, that's a very loaded word, best. How do you determine what is best? How do you define best? Well, I think one of the biggest challenges that traders have is simply measuring trades based on performance or return. In other words, a trade that makes you a 10% return is obviously got to be twice as good as a trade that makes you a 5% return. A trade that makes you a 20% return, there's no possible way that a trade that makes you a 1% return is going to compete with that, right? It's all solely based on return. And of course, that's a fallacy, and that is not how educated traders look at trading. They look at the two major components of a trade, and that is risk and reward. We look at the reward, we look at what the potential profit of that trade is, but we also pair that with the risk. And in our overall trading room, we see that on a daily basis. If your question is, what is the trade that can make me the most money in the shortest amount of time? Well, that's a zero DTE. That's a day trade. You're not going to beat a day trade, but it also carries a much, much higher level of risk. We also have trades that we call the millionaire maker trades. We use them on equities. We're doing two right now simultaneously every week on Netflix and PayPal. We've been doing one for 3 years on I.T.M. That trade has averaged about 1% a week, or in our case this year, a little bit better than 1% a week. Over the last 3 years, never had a single solitary losing week with that trade, and it has averaged 50% or so every single year for the last 3 years. But it's 1% a week versus what we can get on a zero DTE, which is double-digit returns. Today is Tuesday, March the 7th, 2023. We made 11% today. We made an 11% profit today on our zero DTE. Doesn't matter. It's not comparable because all you're looking at is the return. So one of the things that smart traders understand and talk a lot about is what's called the Sharpe ratio. And the Sharpe ratio is just a simple, well, it's not that simple actually, but it's a straightforward mathematical calculation that takes into account how much risk are you actually taking inside of that trade, so that we can compare a trade that makes 1% against a trade that makes 10% and maybe see that the consistency, the risk profile of the 1% profit trade is actually better than the 10%. So again, asking the question, what is the best trade? That's a loaded question, obviously, but I think that if you will utilize the Sharpe ratio to do side-by-side comparisons with strategies and outcomes, you'll get a more apples-to-apples comparison. Now, the Sharpe ratio, again, we just simply take the expected value of the trade. We take the asset return minus the risk-free return. In other words, right now, you can get about 5% return on a 1-year treasury. That is considered a risk-free return. You divide that by the standard deviation of the excess, or what we call alpha of the trade, and it gives us the standard deviation. Now, if that's a lot of babbly-book, basically, here's a quicker synopsis. William Sharpe created the Sharpe ratio in 1966, the year I was born. It's been one of the most referenced risk-return measures used in finance. Much of the popularity is attributed to the simplicity. Again, it's pretty straightforward. It's just looking at not just the return, but the risk you had to take to get that return, and if there was any alpha in that trade. In other words, if you can get 5% a year risk-free in a one-year treasury right now, and the stock market makes a dividend of about 1.68% right now, and that's all you get out of the stock market, or maybe it was last year when it was actually down, you had no alpha. You were not getting paid, you were not getting compensated for the risk that you took. The ratio's credibility was boosted further when Professor Sharpe won a Nobel Memorial Prize in Economic Sciences. So basically, the guy's pretty smart, okay? But the Sharpe ratio, again, is a measure of your excess portfolio return over that risk-free amount relative to its standard deviation, relative to its volatility, its fluctuations. We have a program called the I.T.M program, the asymmetric trade management program. It's not trading, it's investing. Our goal is twofold: to beat the overall S&P 500 on a year-by-year basis, but also, number two, do it at less risk. We measure risk based off of standard deviation. How much is the market fluctuating? How much is our account value fluctuating, okay? So again, the Sharpe ratio, very, very powerful tool in being able to level the playing field on which trade is actually a better trade. So I think as we get into this model on the in-the-money cover trade, you'll tend to see why I feel like it, if it's not the best, quote-unquote best trade that we do in the trading room, it's got to be up there. It's got to be up there in terms of its safety component. So what is the covered trade? Well, essentially, it is just the best of both worlds. As an individual that can trade equities and options, and possibly just focus on the options, possibly just focus on the equities, this is a combination of both of those worlds, and it gives us the best of both worlds in terms of opportunity and cost. So again, we can do this trade in a long fashion. We can do it in a short fashion. In a moment, I'm going to jump into our model portfolio that we use in our live trading room, and I'm going to show you 4 iterations of this trade that we have working right now, actual live trades that we have ongoing right now in our trading room. 2 of them are on the short side and 2 of them are on the long side. But let's talk about the longs first. And this question of opportunity versus certainty. So you guys all understand this risk graph. It's pretty straightforward. The covered call trade, in this case on the longs, we're looking at calls. On the shorts, we're going to be looking at puts. So here we're looking at calls. On the covered call trade, it's pretty straightforward. You know, let's say that we buy a stock at 70. And we obviously think that there's a lot of potential with the stock, or we wouldn't have bought it. And we understand the risk graph and how that works, that if the stock goes up in value, we make money. If the stock goes down in value, we lose money. And so again, we feel like there is a lot of quote unquote opportunity with the trade. Technically, mathematically, the opportunity in this trade at this point is infinite. It's unlimited, because technically, how high can a stock go? Well, there's no limits. Now, we know in real life that's not the way it works. Even meme stocks stop going up at some point. But technically, mathematically, there is unlimited opportunity with this stock. Unlimited opportunity, but no certainty. And so maybe we say, boy, you know, I do feel good about the stock. I do think it has a lot of upside potential, but who knows? And who knows when it's going to happen? Is it going to go from 70 to 100 in a week, a year, a decade? I don't know. We just don't know the answers to that. There's no certainty in the trade. And so the covered call trade is where we would say, all right, I bought the stock at 70. I think it's got some upside, but I'd also like a little bit of certainty. So I'm going to sell a call option with a strike price of 75. Now, that commits me to selling or delivering my stock to somebody at $75 a share. So if, my stock were to shoot up, say, to $100 a share, it doesn't matter. It doesn't matter how high it goes above 100. I am going to be called away at the price that I've agreed to, which is 75. Now you say, well, why would you do that? Well, you're going to get paid for that option that you sold somebody. So now all of a sudden you have a little bit of certainty in the trade. Even if the stock that you purchased long here doesn't go up, you're guaranteed the income that you brought in by selling that call option. This is a call option that we're selling here. So you now have a little bit of certainty. Now, it works exactly the same with the short side of the trade, only we're using puts, okay? So again, let's say that we see a stock that is currently trading at 74. We think that it's way overvalued and that it's going to come down in price. We short the stock at 74. Now, if you're short stock, you know that you're going to make money if it goes down in price, and you're going to lose money if it goes up in price. Now, again, this might be a company that we think is going bankrupt. That we think it maybe is going to zero. That's all well and good. Lots of opportunity there, no certainty. And so to engender a little bit of certainty into the trade, we could sell a covered put down here at $70 a share. Now, that simply means that it doesn't matter how low our stock goes. Our stock could go to zero, and we're still not going to make any more money than this difference between these two prices right here, this $4 difference, because that's the level that we committed to. We sold a put at a strike price of 70 that committed us to have somebody put the stock to us, force us to buy the stock at 70. So we shorted it here at 74. We got it put to us at 70. The difference between the two is our profit. So we have a $4 profit. Now, why again would you limit your profit, or your opportunity rather, to just $4? Well, there's an element of certainty that comes in on this trade. This premium that we brought in here is going to pay us some money. So even if our stock stays the same, even if it goes up a little bit or goes down, doesn't really matter. This money is in our pocket. We keep it no matter what. So that's a little bit of the overview of a normal covered trade. In this particular trade, what we're actually going to be looking at is maybe buying something at 70, covering it in the money, covering it below, agreeing to sell our stock to somebody below the price that we actually purchased it at. We're going to short a stock at 74, and we're going to commit to purchasing it back up here, maybe at 75, 76. So why again would you do that? Well, it brings in, it removes a lot of the opportunity, takes a lot of the opportunity out of the picture, but it brings in a ton of certainty. And remember the Sharpe ratio. The Sharpe ratio, again, is basically telling us that we measure a trade not just on the returns, but on the amount of risk that you're taking in that particular trade. So there's 4 essential steps here to this trade. 3 are required or necessary. The 4th is just a little bit of a bonus, okay? So the 4th step here, keep this one in mind right here. I'm going to come back to it, and we'll show a little bit of an example of that as we jump into the portfolio. But step number one is to sell that call and get assigned a short position, or sell the put and get assigned a long position. So step number 1 in this strategy, we're going to sell a call if we want to get assigned something that we will be in a short position on. We're going to sell a put if we want to get assigned a long position on something that we're going to ride in more of a bullish fashion. Okay, so number 1, sell the call or sell the put. Number 2 is we want to get assigned. So maybe a stock's at 50. when we think it's a little bit overvalued and we say, man, if that thing ever went to 55, it would be really overextended. I would really be interested in shorting that. So we sell a 55 strike price call. If the stock comes up, hits our price of 55, we get assigned that short position. Now we're in step 2. So step 2 is we get assigned. Get assigned that short position, get assigned that long position. Once we have the shares, whether they're short or long, we're going to start to cash flow them selling an in-the-money cover. The key to this trade having an amazing Sharpe ratio, the key to this trade being, I think at least if nothing else, in the running for the title of quote-unquote best trade is this facet right here, selling an in-the-money cover. Not at the money, not out of the money, in the money, okay? And then step number 4, we're going to look at a bonus income addition to this where we can supercharge the trade a little bit, bring in a little bit extra income, okay? So that's sort of the idea of how the setup of the trade works. Let's go ahead and jump into our live trading model and take a look at 4 of these trades that we actually have going on and working right now. Okay, here's our model portfolio. I have a portfolio here that is about $100,000 of capital. This is where we do all of our live trades in Sunday through Friday. We actually start our trading week on Sunday evenings with our Theta Ferry trade, which is an amazing trade in and of itself. So we've got a lot of trades going on. We do about 30 trades a week with about a dozen to a dozen and a half different strategies. The in-the-money cover is, again, one of the most popular ones. So we've got 4 of them working right now, and I want to walk you through a couple of let's go through all 4 of them. 2 of them are bullish from a long standpoint. 2 of them are bearish from a short standpoint. So the first one here that I want to look at is Tesla. So Tesla is one of the long positions here, and we were assigned Tesla stock. You can see I've got 100 shares of Tesla stock in this position. We first sold a put. Now I sold the put at about 136. I believe. If we take a look at our charts here, yes. So you can see my cost basis here in Tesla. It's 136. Now, what's interesting about this is we sold this right in this area, right in here. Actually, we sold it a little bit earlier before that. We sold it up in here. Tesla was about $150 to $155 a share. We said, hey, we think that's a good deal. We would be happy to be assigned at 136. Well, we sold the put. We brought in some income. Tesla actually ended up going all the way down to just about $100 a share. We were still okay in that trade because we had a nice buffer down here from the premium that we brought in from selling that 136 strike price put. So step 1, we sold the put. Step 2, we got assigned the 100 shares. Step 3 is we have been covering this trade now for a very, very long time. Several months now we've been working this trade. So you've got 2 components here in the trade. Number 1, make note that the stock right now is about $188 a share. We're in at 136. But we've covered it at 175. So again, keep in mind that the stock's about 188. And by selling a in-the-money covered call at 175, we've committed to selling somebody that $188 a share stock for the price of 175. It's a guaranteed loss. Why would you do that? Why would you do that? Well, because of 2 very, very good reasons. Number 1, you can see the extrinsic value here that is still left in this trade. So we've rolled this out several weeks now. You can see that we're out 24 days on this. I've got, and you can also see, I've got about $10,000. This is a trade that we're doing on margin. It's about a $200 a share stock. You got to put up half of that, so it's about $10,000. right here in capital that I have committed to the trade. Our goal each week, we roll the in the money covered call out another week. We roll it out, we roll it out, we roll it out. Our goal has been to bring in approximately $125 income per week. Obviously, that's $250 in a 2-week period of time. That's $500 in a 1-month period of time. You annualize that out. That's about $6,000 a year of income off of a $10,000 investment. Now, I didn't go to math college, but I think that's about a 60% annualized rate of return. I think that's pretty good. And that's assuming that Tesla never goes up. Okay, so the cash flow on this trade, in fact, let's just take a quick gander here at rolling this out. Now, this is the evening, the markets are closed, so we're not getting exact quotes, price quotes here, but you can see if we rolled it out one more week here, we would get actually better than our $125, we'd get $185. So again, the trade is working for us. I think if somebody could show you a trade that you felt was one of the safer trades out there, and you're putting up 10 grand to bring in 6 grand a year, that's a trade that you can build some wealth with if you can execute it properly. So that's the idea behind the trade. Now you say, well, what if Tesla goes down? Well, this is where the Sharpe ratio comes into play. This is where we start to really see the advantage of selling an in the money cover. So very quickly, I know this is rudimentary, but there's only 3 things that a stock can ever do, and that is go up, go down, or stay the same. Those are the only 3 things that I know that a stock can do. And so if there were a way to build a trading strategy setup that would allow you to make money in all 3 directions, up, down, and the same, I think you're going to find in the Sharpe ratio mathematical model, it is one of the quote-unquote best trades that you can make. And that's where we're at here with this Tesla trade. Now, you can see that here, this little green flag right here, that's where Tesla is currently at price-wise. You can see that it doesn't matter how high Tesla goes. Tesla could go from, $190 a share now to $900 a share. Doesn't matter. There's no more opportunity left in this trade. There's only certainty. And the certainty is that this $639 of extrinsic value will be mine. It will come into my account over the next 24 days. Okay? Doesn't necessarily guarantee me a profit, but when I know that I'm going to be bringing in $639 about every 3 weeks on a $10,000 investment, gives me a lot of wiggle room. Now, again, when we talk wiggle room, what are we saying? Stock can only do 1 of 3 things: go up, down, stay the same. If Tesla is to go up, we make money. If Tesla stays the same, we make money. And if Tesla goes down, we make money, as long as it doesn't go down below this number right in here, which is about $111 a share. Now, Tesla's almost 190 right now. What are the chances? What are the probabilities of it going almost in half in the next 3 weeks? Well, statistically speaking, they're pretty low. Probabilities of that happening are low. So it's obviously not a guaranteed return, but when you can build a trade like this, that again can make you a 60% of your cash flow, and your trade can, your stock that you're trading can make money for you if it goes up, if it stays the same, or if it goes down. That's a pretty powerful trade. So that's one that we've gone through all 3 steps. Now, the step number 4 that I'm talking about, we don't have one on right now here on Tesla, but the step 4 here is the supercharging effect of this. And that's where you come in here and you say, okay, I understand the risk graph now. I understand that I am capped at my profit potential here based on the in the money cover that I have sold. So again, doesn't really matter how high Tesla goes. There's no more profit left in this trade for me. Well, we can actually supercharge it a little bit. We could go sell a credit spread against it here. And I'm just going to throw a little bit of capital at this, not too much, but let's say about $1,100 here. You can see on this trade, if I put another $1,100 in the trade, so now I'm going from about $10,000 to $11,000 in the trade, and it's over a 10-day period of time. Let me see if I can slide that window down a little bit. All right, there we go. So if I sell this call credit spread, I'm going to be putting up about another $1,100. I'm going to be bringing in about $230 in extra income on top of that trade. So that's over 10 days. That's potentially another $600 a month in income. Now, what does that do to the overall look at the trade? Well, you can see right here, it does take a little bit of the profit potential out up here, but it also adds a whole lot more certainty. Certainty is the income, opportunity is the growth factor, right? No growth potential in this trade, but lots of income potential. If you can make now close to 120% a year return on what we would consider a very safe trade relative to a uncovered trade, maybe you got a good opportunity there. So that's our Tesla trade. Now we go down the list here. I've got another one. This is HOG. This is Harley Davidson. This is a trade that we have been stuck. I say stuck. We've been stuck in the first step of this trade going on 4+ weeks now. So HOG, if you take a look at it in the chart, it had an earnings report. It had a nice pop here. It was, to us, technically very, very overextended to the upside. We felt there was a high probability that it would fill that gap. And so we wanted to short some shares of HOG up here and ride them down and potentially make some money off of that. So while it was up here around this $50, $51 a share level, we started selling these naked calls so that we could get assigned a short position. Well, as you can see from the charts, obviously the very day that we started that, it's done nothing really but fall. So we have been working this trade now for, again, basically a month, basically 4 weeks, just rolling the naked call out, rolling it out, rolling it out, rolling it out. We've done it 4 times each week over the last month, and we still are in step 1. We haven't gone to step 2 and gotten assigned the short shares. So is it a failed trade? Well, it's not really a failed trade. You can see that because I haven't been assigned 100 short shares yet, I'm only putting up a little over $600 of capital into the trade. I'm bringing about $40 per week of income into this trade. It's roughly about 6% a week or 24% a month. We've made about a 24% return over the last 4 weeks on this quote unquote failed trade because we haven't been able to get past step 1. We haven't gotten assigned the short yet. Are you okay making 24% in a month on a trade that doesn't work? It's a pretty nice setup. So we're pretty happy with that one, although we're continuing to work it. The next one here is Coin. Coin is the second iteration of an in-the-money covered trade that we've done with this particular ticker, this underlying. We just completed one about 3 months ago where we brought in about 10% return in less than 20 days. Again, pretty darn good rate of return. A lot of safety was built into that trade. We've got a similar situation going on here with Coin, but it's not quite as powerful as the Tesla trade. So if you look at our Coin position, you can see that we were assigned 100 shares at 62.70. So we sold the put, we got assigned. You can see that since we've been assigned here, Coin has really done nothing. In fact, we're actually just slightly lower right now on price than we were when we got into the trade. But if you look at the trade, we got in, and we immediately sold an in-the-money cover. Stock's almost at 62. We sold a 56 strike price call. And again, you say, why would you own stock that's $62 a share and commit to sell it to somebody at 56? That seems like a guaranteed almost what? $6 loss? Well, it is almost a $6 loss, or $600 on 100 shares, but we also brought in almost $800 in income. So you brought in 800, you're going to lose 600. There's a $200 arbitrage play there. This is a $3,300 investment. That's about 12% a month in cash flow that you're bringing in on this trade. That's darn near to 140, 150% a year cash flow on this trade. And again, you can see the setup that we have talked about. It's very similar to what we have going on with the Tesla trade. Our coin trade here will make us money. If coin goes up in price, it will make us money if coin stays the exact same price, and it will make us money if coin goes down. And coin can go all the way down to about $54 and change, almost maybe $55, before we ever start risking a penny of our own personal money in this trade. And again, we are just continually rolling this cover out to bring in more and more income on this trade. It's been an absolutely fantastic trade. Anytime we can find a setup where we feel like we have an edge, one of the mantras in our trading room is we want to trade with an edge. And just certainly going out and saying, I like this stock, I'm going to buy it. I hate this stock, I'm going to short it. You might be right, but there's no edge in that, okay? When we can make money off of something, whether it goes up, down, or stays the same, we feel like we have an edge. And when those returns can approximate or get close to 100% a year annualized numbers, those are pretty impressive for us. We perk up a lot at that type of a level. So those are a couple that we have. We also have another one here that is working from the short side. This one is one that I'm very, very excited about. It's on Wynn. It's on the casino company. Now, we're still in step one here of the Wynn trade. You can see we sold the call that commits us to shorting this stock at 111. Well, the reason I'm very excited about this one is we're at 113. We've already committed to short this at 111. It's already 113. So chances are pretty darn good that we're going to move to step two on this particular iteration, and we're going to get assigned those shorts, and then we will sell the in-the-money put, and we will start generating some cash flow on that. But the thing that's interesting about the Wynn trade is that you can see, again, I got about $4,900 of capital committed to this trade. I brought in a little over $500 of income on the trade by selling this call option, and it expires in a little less than 2 weeks. So again, when you can bring in an approximate number of 20% a month cash flow, that's 240% a year. Before you even get to the next step of the trade, step two of the trade, we love it. We think it's a very powerful trade. So those are some overviews of 4 of these in-the-money trades that we actually have going on right now inside of our trading account. So again, this is basically our setup. These are the steps that we use to trade the in-the-money covered call or the in-the-money covered put, as the case may be. Again, step 1, sell the call or put to work towards getting assigned. Step 2, get assigned. Step 3, start generating the cash flow by selling that. Step 4, if it is appropriate from a delta standpoint, and this is something that we'll get into a little bit more in detail if you are inside of our live trading room with us, we will supercharge the trade by selling either a put spread against a short position or a call spread, credit call spread against a long position. But it gives us a tremendous amount of certainty. It also gives us a rate of return potential that we are just absolutely pleased with. So that's the overall the idea of the trade. If you are not in our trading room, we'd love to have you come check it out. We have a 2 times your money back guarantee. I put you through 4 hours of training. You and I have a one-on-one Zoom session, a strategy session where we go through our trading strategy matrix, try to align a trading plan for you. And if you go through all of that and you do not believe it is the most amazing value-added trading room out there today, I'll give you double your monthly subscription back. Never had to do that yet, as long as you go through the steps. So who are we looking for? Who's a good trading candidate for our program? Number one is experienced traders. We do very evolved high-level trades. There's a good chance, no matter how experienced you are, that you will find trades that we do in our trading room that you've never done or seen or heard before. So it is important that you understand options and understand how they work. Also, if you are in a trading room right now and all they are giving you is a zero DTE strategy, yeah, they're popular. Yeah, they're fun. Yeah, we do happen to have the best documented track record on the internet for zero DTE results. But if that's all you're getting, they're taking advantage of you. You should not be paying money to subscribe to a trading program that gives you one strategy. That's gambling. That's gambling. That's not how professional traders trade. Number two, if you're ready to upgrade your trade, if you're already in a trading room but you didn't get a real free trial, they still charged you money to come check them out. That's a little bit of a red flag. Results transparency. Every one of our trades is documented, time-stamped, and logged inside of our Discord server, and they're there for any member to see. So good, bad, or indifferent, you always know what the actual real-world results of our trades are. Market commentary every day. Every day we start off with my market commentary. I go through my directional biases, and I go through my support and resistance levels. Those are the levels that we trade the zero DTE off of. It's one of the reasons why we have one of the best track records out there with zero DTE. And it's also, of course, because we trade dynamically versus statically. And we have, again, that 200%, that 2 times your money back guarantee. And you should, on a $100,000 portfolio, have a real opportunity of making $1,000 a day. That's not a guarantee. That's not a promise. We never know what we're going to get out of the market on a day-to-day basis. But we can define opportunity. And if you're trading zero DTEs, where you don't have a realistic shot of making $1,000 a day, again, it's probably time to step it up. So if you meet any of those criteria, probably a good fit for our trading room. You can come trade with us for free for a week, interact, talk with our members, see if they don't convince you it's the best place possible to be trading. They're a great group of guys and gals. You can go to Try Zero DTE for free. We'd love to see you in the trading room.